Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. We're covering earnings reports this week. In this video, we have our senior equity analyst, Ben Nye, discussing Wells Fargo. Thanks for joining us.
Okay, well today we're going to be talking about a variety of earnings reports on Wells Fargo. Geez, Wells Fargo. I think we've all seen the headlines on Wells Fargo over the last quarter, and they have not been good. And unfortunately for them is that a lot of these sins took place under a different management team, under years and years ago, and the consequences for actually what happened are relatively mixed. I mean, who's actually been materially hurt by this account scandal where they created a phony account? Yes, the account representatives at Wells Fargo got paid a little bonus, but does that actually hurt the consumer in a material way? I think that very much remains to be answered. That's an unanswered question right now. However, Wells Fargo has drawn the ire, the vitriol, as the next bank. You know, Americans love to have a bank to rag on, and Wells Fargo has been that one. It used to be Goldman, and then Goldman passed the buck, and then it was J.P. Morgan. Remember that London whale? Then Bank of America, no one ever likes Bank of America, but now you got Wells Fargo. So all these other guys, they're excited and relieved that now they have Wells Fargo as kind of the one to just kind of flog. And that's what's been happening. In fact, they had this consent order at the end of January, which really rocked the stock. I mean, the stock fell from mid to low 60s, and now it's down in the low 50s. And part of that's due to just weakness in financials in general. But part of that's also due, and a large piece of that's due to the fact that they cannot grow assets. They are legally not allowed to grow assets until the Federal Reserve allows them to. What's really interesting about this is that the company agreed to it, and no one has talked about it. Only the management of the company talks about it. You listen to any of the Federal Reserve public appearances, they don't talk about it. No one asks a question about it. I was at lunch with the Federal Reserve Bank president for Atlanta, and for the Atlanta district, and it was a CFA luncheon, bunch of supposedly smart people in the room, and none of them asked a question about, is this really under the purview of the Fed to restrict the ability of a bank in the United States to grow assets as a punitive, we're talking a punishment for something that happened years ago that didn't really pose a systemic risk. I don't think anyone would say that opening phony accounts pose a systemic risk to the American banking system. But, that's what happened. And Wells Fargo, they know their position right now, and they have to be the contrite, humble player and play along with whatever the Fed's political games are. And if that's a Yellen parting shot, as she was fired from the Fed, then so be it. And to Wells Fargo's credit, CEO Tim Sloan and the rest, they have now, as they disclosed in their quarterly call, they supplied a plan of action to the Fed. They're waiting to hear back on that. Need the Fed to sign off of that, and then continued monitoring. They actually hired the New York Fed regulator, Sarah Dahlgren, I believe her name is. So they actually hired the New York Fed regulator to go work for them, and she is now the liaison between Wells Fargo and the regulators. So they got an inside man or inside woman on the job. So they're doing the things that they need to do. They're playing by the rules, the Fed's rules, even if they're making them up as they go along. So if we talk quickly about what actually happened in the quarter, the problem for Wells Fargo is that when you're involved in a situation like this, there are so many one-time items. And it's just they're just not clean results. And in fact, Wells Fargo this quarter had a number of items that were not clean, which actually benefited on net. By my estimate, although the company actually ended up beating earnings expectations, they posted a EPS, earnings per share, of $1.12, and the estimate on the street was $1.06. By my estimate, they had about 20 cents of net of taxes, one-time gains, and that includes gains on sale. That includes offset somewhat by one-time net losses. They had big reserve release because they reserved a ton of money, which means they basically took a lot of profit off the table on their balance sheet after Hurricane Harvey, because they said, we may have a lot of losses off this. They said, okay, now we're 6 months past Harvey. We're going to release this money. We actually didn't have to pay it. So that's going to boost our earnings for this quarter. In addition, they took a $200 million gain on mortgage servicing rights. Mortgage servicing rights are basically the 25, 50 basis points, 0.25 to 0.5% of your mortgage that you actually pay every year with every mortgage payment, actually. And basically, this is the fee that you pay for someone to service your mortgage, which, and you would say, and I would say, well, that's why they get the mortgage payment in the first place. You don't have to pay them extra for the privilege of taking your money, but that's what you do with mortgage servicing rights. Anyway, so Wells Fargo owns a lot of these because they originate a ton of mortgages. And when you value a mortgage servicing right, you have to estimate the future cash flows of that mortgage servicing right. If interest rates go up, that reduces the risk that you'll refinance. If you refinance, you could use someone else, and that mortgage servicing right goes to zero unless Wells Fargo can win the origination business on that refinancing. So you actually get a little bit of benefit from extension in the mortgage servicing right. So if interest rates go up, reduces the risk you refinance, and increases the value of a mortgage servicing right. And so Wells Fargo booked that in the quarter, which certainly helped on their earnings. In terms of net interest margin, it came in a little bit light, 2.84% versus estimate 2.88%. But the real issue for Wells Fargo is that they need to get the efficiency ratio right. I mean, they're in the mid-60s. They said they wanted to close this year at 59, or at least below 60. And now they say they're not going to be able to do that because of the asset cap, et cetera. To me, that's a little bit of a weak excuse. It gives them a little bit of cover not to improve on the productivity. They do say that on a dollar-by-dollar basis, they're going to be able to hit those productivity and efficiency targets. And especially as we go into 2019 and 2020, they'll be able to move that efficiency ratio down, which means their margins will be going up. But unfortunately, that did not happen in Q1. Analysts are peeved about it. And I think visible improvements in the efficiency ratio may not become clear until the second half of 2018 at the earliest, which is to say, right now, I think you almost get a little bit of a laser focus almost on the efficiency ratio at the expense of seeing the broader picture, especially from the analyst community. They almost pick one number and judge management by that. And if they're not hitting that number, then they're not going to boost the stock. And I think that's the issue that you have with Wells Fargo at the moment. And again, resolution to that will probably not happen until the second half of 2018, maybe into 2019. So Wells Fargo remains a stock in flux. It remains a company in flux. They claim to be doing the right things. I think they are doing the right things, but fact of the matter is these turnarounds take time, and I think that's going to continue. So we'll see more when Wells Fargo gets its authorization for share buybacks and dividends from the Fed. It should happen in the next couple of months or so. So keep an eye on that. Right now, Wells Fargo, mixed quarter. I can't really say that it is unexpected. I think you pretty much knew Wells Fargo was going to have some headaches. And it's just going to be a messy story. it's sloppy.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.